Under surveillance this morning, going for gold.
In the short run, we think gold could go down to $2,500 an ounce. And part of it is just that those tariffs, the downside risks. We're also seeing interest rates going up in the U.S. These are important elements for gold because gold was pricing in a pretty steep rate cut path. If that doesn't happen, it's going to be choppy for gold for a bit. Ultimately, if inflation comes back, gold will be a good place to be. So I would say maybe buy the dip in gold. We still think $3,000 an ounce is kind of the target for next year.
So here's the latest this morning. Gold catching a bid through this week, rising alongside demand for haven assets as geopolitical risk and policy uncertainty hits markets. Samantha of Goldman Sachs writing, U.S. policy uncertainty and recent consolidation provide an attractive entry point for our high conviction long gold view. We keep our view at 3,000 for the end of 2025. Samantha joins us now for more. Samantha, good morning.
Good morning.
Before we talk about where we're going, I think we need to talk about where we've been and where we are right now and what's behind it. You've identified a whole host of tailwinds for gold. Central bank buying, fiscal sustainability, trade tensions. Of all of the reasons, what's the dominant factor for you in 2024?
Yeah, it's central bank buying. In fact, it's been the dominant driver of the upward gold move since 22. The moment that Russian financial assets were blocked, then that sparks a lot of concern from a lot of emerging markets and China in particular that, who knows, this might happen to them one day. So central bank buying has stepped up significantly, fivefold from the average that we observed prior to 2022.
Do you see that continuing in 2025? And do you see policy changes in the United States that will just exacerbate some of the trends that we've seen?
So on the EM central bank buying, we definitely see that continuing. When you think about how much reserves they have in gold, it's still very low compared to what DMs hold. So the structural driver is there. But I think on top of that, the other interesting story is that for the longest time, ETFs were not a part of the story. And I think the moment the Fed started cutting, then that's what opens room for ETFs to come in as well. So when you think about physical buying in this market, central bank buying is the primary driver, but now you have on top of that the cyclical support from ETF buying as well. So safe haven is just the cherry on the top, right?
So this is actually a really important point at a time when sometimes when gold goes up, people call it an inflation hedge. Sometimes people call it a haven trade if there's geopolitical risk. Are you saying that that's all just creating a narrative around a fundamental structural story that's playing out with central banks and what they're doing with gold?
Yeah, I think especially the safe haven aspect is very much a part of the risks ahead. There is a lot of policy uncertainty ahead. Clients have been very focused on, will there be a tariff escalation scenario? And that can bring uncertainty, and that's usually what triggers higher positioning and that notion of safe haven buying.
Well, I guess that the reason why I ask it this way is because we're wondering how clean some of the previous haven trades are. We ask that about treasuries, given the fact that people are worried about the deficit. We ask that about oil, given the fact that the supply-demand dynamic has changed, given the renewables. And we ask that about gold, given that there are some other unique benefits. Do you think that gold and oil in particular are still the best hedges for that uncertainty, even more perhaps than other asset classes?
I think even gold more than oil. When we think about inflation, oil is a fantastic hedge when that inflation is coming from a supply disruption, to be sure. But the risks ahead, I think, include more than that. Yes, there is a concern with what's going to happen to Iranian supply. Mm-hmm. That's fair. But on top of that, tariff escalation risk, or even, as you mentioned earlier, that growth fears. So I think gold offers more reasons for investors to belong right now. And really what I think the dominant driver has been is this structural support from central bank buying. Just like the sheer tons being bought, and we just got the latest data for September, which shows that high rate of buying has continued. So this is really the primary driver, and the safe haven notion, the hedge against inflation, we think goes on top of it. In fact, when we think about the highest risks associated associated with tariff escalations, with debt fears. We think this can take prices even above our 3,000 forecast for the end of next year. It's not a base case, but it is a risk that we have been highlighting.
Samantha, when you put all these tea leaves together, especially the central bank buying, is this the start of de-dollarization that we could see bleed out, even in a bigger way, in the global financial system?
We don't see it that way. We see it as maybe a rebalancing of the way that financial and monetary authorities hold their reserves. So just being a little bit more diversified.